Hey, it's Nathan Crampy, and today we are going to be talking about will inflation derail your retirement? And there are going to be 5 strategies and key takeaways with our time today. And with that, here are the 5. Point number 1, inflation will cause you to overspend. So when we take a look at inflation, the worry that inflation actually is entailing us and the things that are making us be really worried about inflation is the fact that we have the propensity then to overspend on the things that we need. So why is that such a big deal? Well, that comes back to my number 1 risk of retirement is outliving your money. So if that is a number 1 risk, that we have a money set aside, an amount for retirement, and we have the worry that we're actually going to be outliving it, meaning we don't have enough savings, then what the ultimate issue is, every little increase in prices, whether that's food, whether that's gasoline, whether that's just everyday commodities like clothing that we need to be wearing, all of those things, as they go up in price, well, that is a worry that now we are spending more than what we had designed our retirement for, and now we need to be worrying more about, are we going to be spending more and spending enough that is going to actually derail our plans because we are going to outlive our savings. So when we take a look at this, the ways that we plan for this is through different scenarios. So we can actually say, what if inflation is sticky high? What if we're at a 3.5% or 5% year-over-year basis that we are growing? And today, maybe that's even more. Maybe it's 8%. So if we're taking a look at all of these numbers and saying we're going to have sticky high inflation for a foreseeable period of time, well, then we have to say to ourselves, how is that going to affect our retirement? So planning for it then is saying, well, let's take a look at what happens if we have high inflation. I am going to need to spend money. I'm going to need to spend more money than I had anticipated. Will your plan that you have in place for your wealth, will that be sufficient to mitigate any and all inflation risks that are out there? You see, knowing is, in the words of G.I. Joe from many years ago, half the battle. So today that comes into a different type of a feel. Now it's basically saying that if we know the data and we have the data, the analytics behind it, then we can start making the correct choices. So while both are saying the same thing, it sounds better to actually say knowing the data and the analytics to create the choices. That's what we want to do. We want to look at where you're at today. So what that looks like then is taking a look and saying, well, this is what we had planned for. Do we need to make changes to the plan based upon that inflation? So the inflation then is another known that we can plug into the models and start saying, all right, well, let's say we have a higher amount of inflation. No longer is it going to be 2% that we have been accustomed to for the last, say, 10 years, 15 years. Now, maybe it's going to be higher. So like I said before, maybe it's a 5% or an 8%. So knowing that difference is going to make sure that we can start modeling if indeed you will have money left over at the end of your life, or if you're going to have life left over at the end of your money. Knowing those factors are going to come into every other key aspect that you do with your retirement savings. So when we take a look at Social Security, that's a big piece of your income in retirement. So much so that you most likely will become a Social Security millionaire by how much you have drawn from Social Security over the years. Now, Social Security is going to be most likely larger than the house that you live in, and with respect to how much money you would receive from it. Let's say if you sold the house, it's going to be larger, most likely, than your portfolio. So Social Security is a big deal. Now, also, if you have the nicety to have a pension, that's going to add to another piece of the puzzle. So we have Social Security, we have a pension. Those are going to provide support. If you have annuities, annuities are going to provide another level of support. So now we have a base. Well, off of that then, now we start saying how much more above and beyond Social Security, pensions, the annuity income that you have, do we need on a monthly basis to maintain the same standard of living that you want? Well, that is the planning stages. That's what we come back to, and that is the help that you can be looking forward to when we look at if inflation will start derailing your retirement. Again, knowing the information leads us to that second point then. And the second point of will inflation derail your retirement? Well, it comes back to saying maybe it is. Maybe as of right now, the data suggests that it will. Well, that is saying, well, what do we need to do about it? So enacting plans to make those changes. And the best ways that we can be looking forward to work with inflation is by utilizing the correct investments that will grow with inflation. You see, not every investment and asset is the same. So when we take a look at real estate, for example, because real estate is known to go up with inflation. Well, there's also cyclical natures with real estate, and maybe we are in a time period where we've already had that growth established. So the growth in your house, the growth in your cabin, second home, all of those have already appreciated. So they may not be appreciating more in, say, the next year or two. Well, that is good to know. So maybe we don't want all of our money in real estate then. We're going to be spreading out, and there are other aspects of in the investments that you choose that you could have basically the ability to be invested in. So there's what's called TIPS. Those are inflation protected treasuries. Well, those came about as a way to guard against the inflation because they go up in price with inflation. Now, there are some hardships with those as well, because even though inflation may be going up, TIPS may not actually keep up with inflation in the way that you are expecting and wanting. So that's also another way to say know your investments, because even though they are specific for inflation and protecting against inflation, they still may not do exactly what you want. Well, there's other areas, and there's going to be stocks that are able to grow with inflation. There are actually some very good companies that do incredibly well in inflationary environments. So knowing those types of companies are going to be very helpful for you. Very helpful for your portfolio, because we can be invested in those, and if we're outpacing inflation on a yearly basis, then that says that, going back to our first point, that the plan that we have in place can still be viable. So we have those types of stocks that can be going up. We have types of bonds that may work, especially ones that are inflation protected. Well, there's going to be other areas that you can be looking into as well. At times, maybe even commodities. You see, commodities, if inflation is going up, it's because the prices of those commodities generally are going up. So that could be anywhere from corn to wheat to oil, natural gas. All of these things can be good inflation protection. But here's the thing. Those are some of the most volatile places to be invested. So while we take a look at other types of really interesting types of investments or gambling types of things like cryptocurrencies, Bitcoin, all of that realm, inflation is the second highest amount of volatility outside of those crypto spaces, which means they can go up 100% over the course of a couple months, and they can collapse 75% in the matter of a couple months, or sometimes even a couple weeks. So they can go up and down very violently. And that is obviously not a good thing when it comes to wanting to have growth that's going to keep up with inflation. So commodities have the ability to be a great place, but you have to know what you own and you have to be watching them. So we have the housing market can be great long term, but there's going to be some fluctuation short term. We have commodities that will be there over time, but they're going to be very volatile. We have treasuries that are going to increase with interest rates, but they may not be exactly how you designed it. So just knowing what you own and making those changes in your portfolio to be adjusted for the period of time that you're in is going to be very helpful. Okay, so the third point that we want to be coming back to then, this is related to inflation, but it comes back to our risks. So if the risk is that we outlive our savings, our retirement savings, healthcare is a part of that. You see, healthcare, if we spend more on healthcare, then we're going to be taking more out of savings, more out of your portfolio, and that alone is going to cause hardships as well. So recently, I've done a lot of work and studies and figuring out what people are expecting to be some of the hardest areas of retirement to account for, and healthcare was number one. Well, again, it's because of the fact we don't have a known of what the price of healthcare is going to be for premiums. We don't have a known of what the cost of healthcare is going to be in the future, and pretty much all of healthcare continues to increase in price, meaning inflation. So it is very real when it comes to healthcare, and the best thing to do with healthcare is to know your insurances and have the correct insurances. Because what we don't want to do is come to a point where we think we may have a $2,000 bill over the course of the year, but that turns into a $100,000 bill. It's going to be hard to sustain taking out hundreds of thousands of dollars out of your portfolio on a yearly basis for healthcare without the insurances and without saying that you're going to have the money available for your needs in the future. So whether we have the money set aside for retirement and we're worrying about a legacy, well, that can derail our legacy. Whether we want to make sure that we always have the correct amount of money set aside for retirement, or let's say we do have enough. You've done a great job of saving. Your business has been doing well, and we've been able to put away more into some plans that are setting hundreds of thousands of dollars aside on a yearly basis for you. Maybe you even sold your business. Now you have millions that has been coming into your bank accounts. Well, that's great news. But if it comes back to that we're paying more in healthcare, well, even that amount of money could feel like it's not enough. It could feel like you may be taking on too much risk. And so healthcare is a big piece of that, and increasing your coverage to account for all of the different inflations is going to be vital. So always be taking a look at your healthcare premiums, the insurance coverages that you have, not only for your healthcare, but you can also take a look at even your house, your car, your auto, your property casualty, maybe for your boat. All of those can be having the correct insurances so that you know that no matter what, I have to pay a specified amount on a year. If something bad happens, you have an actual out-of-pocket maximum that you have to be in charge of. That is one of the best ways to curb overspending, to curb the inflationary pressures that are out there, is by making sure you have the correct insurance coverages. Now, the last aspect with insurance coverages obviously comes back to long-term care as well, and that is something that is getting harder and harder to find, and it's something that is actually being harder and harder to pay out when needed. So knowing how you're going to be working with long-term care is going to be vital as well, because you may be thinking that I may pay $5,000 a month, and it turns out to be $15,000 a month. You may be thinking I need a level of care today that may be different than in the future. So if that happens and the unexpecteds crop up, have a plan. Have a plan on how you're going to deal with long-term care, because most likely, in one way, shape, or form, you will probably need at least some sort of coverage. Now, it doesn't mean you're going to be going into an assisted facility. That doesn't mean that life is going to all of a sudden look very bleak. But you may need some assistance of someone coming into your home on a daily basis, weekly basis, to provide some level of care, and having those types of insurances or the money set aside is going to make sure that you don't outlive your money. And that ultimately, going back to inflation, is what is such a huge issue with inflation. Okay, so let's keep going here. We have item number 4. It should be very easy to understand this, but sometimes concepts, what we're talking about here, change. So what do I mean by that? 4 is don't take on unnecessary risk with debt and the debt levels increasing when interest rates are going up. So what we don't want to do then is say that we want to be taking on more and more debt. So we want to be, say, refinancing our house at a higher interest rate. We don't want to take on more credit card debt. We don't want to be purchasing more things that are going to be at high interest rates, because see, what happens is, first of all, that's going to be an expense that we need to actually be accounting for on a monthly basis. So when you take a look at your cash flow, the amount of money you're spending, that's going to hurt us, because that may say you may overspend. Maybe we do need the new car. That's perfectly fine. But how can we look at that and pay maybe a little bit in cash, a little bit in financing, do things correctly so that the financing piece, the high interest rates, don't come back and hurt us? And obviously, if we don't need to be buying it in an environment with high inflation, then maybe we don't. Or maybe we trade down so that it's saying, instead of buying the $100,000 car, we buy the $60,000 car. Or the $60,000 car goes to a $40,000 car. And all of that is doable, but also that may mean that there's going to be other sacrifices that come about from that. So it's knowing where you're at. Again, that plan is so vital, because we don't want to overspend. We don't want to have higher levels of interest in what we need to. And also knowing that we can be, in the future, possibly refinancing as well. So maybe we absolutely, no questions, need to be purchasing that today, putting things on the credit card today, buying the new house today. That's perfectly fine. But if we know that we can refinance in the future and actually reduce those costs, those fixed costs, that's going to be more helpful as well. So that leads us to our 5th point, is knowing if inflation is going to be what the Federal Reserve and a lot of people in Wall Street like to say, transitory, which is basically a fancy word for temporary, or is it more persistent? Is it more lasting? See, that is going to be the huge driver to say, do we need to make permanent switches, permanent changes, or can I just temporarily make changes? You see, when we take a look at going back to cars, the things that we need to be purchasing, well, maybe it means that it's a not yet. Maybe it means that we wait 6 months and we're going to get a better price or better interest rates. All of that is on the table when we talk about whether inflation is going to be more temporary in nature or whether it's going to be ongoing and persistent. So that is what we need to be thinking about. Now remember, one kind of thought process here is that over the last 40 years, inflation has been habitually and continually going down. And the trend is down, and you always say the trend is your friend. So while we have spikes that happen, those spikes may or may not be long lasting. But if the trend is down in this case, then most likely you will find better places and better opportunities in the future. Now, that's not saying it's always going to be that way, but history right now is showing that the trend is down with spikes that do happen, of course. But if that's something that we need to be banking upon, the high probability is that we will start seeing disinflation happening, which is a slowing of inflation. So that's one other aspect to be considering, is the timing of your purchases. Hey, if you liked what you heard here with respect to inflation, to how inflation can derail your retirement, there are plenty of other videos, there are plenty of other resources that you have available here. Now, please go ahead and check out some of this other content that we have here, whether it's investment management, whether it's talking about the different advanced planning aspects that we have here, because we can talk about estate planning, we can talk about investment management, wealth transfer, wealth protection, charitable giving. All of that comes back to bettering your financial future. Now, with that, I look forward to seeing you in many different videos, but here is a special bonus clip just for you. It's easy to sit here and say that inflation is going to continue because that is what we have been seeing for the past year. So when we take a look at what is going on in the economy today, we have to take a look at where inflation is going. Now, already the Federal Reserve has basically come out and said they want to fight inflation at all costs. And you know what? I believe them. I believe that they are going to do whatever it takes to fight inflation. You see, that is a huge political opportunity that is out there now. That is a huge aspect around the world, that we have the banks, the central banks around the world that are coming together to try to fight inflation. So they're going to get their wish, and that's by higher interest rates. So as they keep raising interest rates, that will in effect basically cause things to change with respect to inflation. Now, here's the way it does that, because we raise interest rates. Now, that alone doesn't just say, all right, inflation's coming down, but what it does is curb demand. So if we go back to Econ 101 just from high school, we can actually start to see how this all starts to work out. So if we reduce demand, but we are either keeping supply the same, or in this case, what's starting to happen is supply chains are starting to open up more. We're starting to see more supply come online from, say, a year ago. Well, supply may increase and prices are coming down because of demand coming down. So all of that is a disinflation. So it may not be outright deflation where prices are really starting to go down, where we actually are looking at and saying prices are less today than they were yesterday. That may not happen, but what we talk about is the rate of change. And all of this is mathematics that means something, because when we talk about the rate of change, we talk about the slowdowns that are starting to occur, the reduced spending that is happening. All of that is cause for concern when it comes to the economy. You say if we're spending less, then the companies that we are purchasing from and purchasing less from, they're not making as much in profits and margins that they have. So if that's the case, well, then things change. So we have a slowdown of what the Federal Reserve wants, our consumption. If we consume less, then the companies that are consumption driven aren't doing as well. So if they're not doing as well, they're not going to do as much in ordering for more supplies. So whether that's a new hot tub, a new car, whether that's just the clothing that we wear, all of that means something. So if they're not ordering as much as supplies, ordering from the manufacturers, well, then we really come back to saying that those manufacturers aren't going to be producing as much. And now you can start seeing the spillover effect that happens. So the Federal Reserve has already said that they are going to continue to increase interest rates to lessen our demand for products, because it's costing more to finance, it's costing more for companies to finance just making the products. All of these things cost more. So in this case, the cure for higher prices is actually just that, higher prices. And that is really what the economy is looking at right now. That's the reason why the stock market has not been doing as well recently, because we are continuing to increase those interest rates. Well, here's the thing. At some point, the Federal Reserve is going to stop. At some point, they're going to go the opposite direction and start to lower interest rates to start building us to spend more. When that is, and at what point that is, no one knows. But here's the thing. Most likely, that's going to be different than where we're at today. That's going to be different than the environment that we're in today. And only the Federal Reserve knows that, but if they're making decisions based upon data on a weekly and monthly basis, then they may not know yet. And if that's the case, then the prolonged pain that we feel in the stock market may be here a little while longer. So if that's the case, then make sure that while we're trying to do our best to fight inflation, to grow the assets with inflation, it's going to be much trickier, because we need to be even more precise on which investments we want to pick and be invested into, and which ones are going to be more risky to own. They may have not been risky, say, a year ago. And think about bonds. Bonds in and of themselves have a component that we call risk-free, because of the fact that they're backed by the full faith and force of the government. So there is what's called a risk-free way to look at bonds, especially treasury bonds. But if interest rates are going up, bond prices are going down. That's the inverse relationship here. And because of that, they may not be the correct place. So knowing what's correct, knowing what's incorrect in the environment that you're in, is going to actually say, how can I be risk managing my hard-earned wealth to avoid the pain, be ready for the future when things turn and we need to be more growth-oriented. But in the meantime, how can we continually work with inflation? That is what's coming. But if disinflation starts happening, it will actually make your investment life much easier. So keep an eye on a disinflation, a slowing of inflation, for key changes in the investment front that you can capitalize on.